wealthbranch.com.
Discount cash flow explained. Price is what you pay, value is what you get. Warren Buffett. Have you ever wanted to know what a stock is worth, or if something is a good investment? Let's say I offered you 3 investments. Investment A, I'll give you $1,610 in 5 years, represented by future value if you invest $1,000 today, known as present value. Investment B, I'll give you $25,938 in 10 years if you invest $10,000 now. Or investment C, I'll give you $202,000 in 30 years if you invest $20,000 now. Both investments A and B represent a 10% return. Investment C represents an 8% return. But all investments were calculated using future value calculations. When we calculate DCF, we're trying to figure out if the future cash flows are worth more than the present value of the cash. Moreover, if we run DCF calculations and find that the present value is more than the current stock price, the stock is considered overvalued. Intrinsic value versus discount cash flow. When Warren Buffett talks about intrinsic value, he is often talking about discount cash flows. However, he most likely also thinks about the intrinsic value of other assets, like the company's brand name, moat, and real estate, among other things, giving him a broader valuation of intrinsic value. But the discounted cash flow model gives us a method to quantify the value of a business. Let's see what Professor Damodaran has to say about intrinsic value.
In intrinsic value, you're trying to value a business based on its cash flows, its growth, and its risk. And discounted cash flow valuation happens to be one tool that can be used to estimate intrinsic value. The reason I emphasize that is a lot of people equate the two. They think that discounted cash flow valuation is always intrinsic value, and intrinsic value is always discounted cash flow valuation. That may or may not be the truth.
When evaluating an asset with the DCF model, there are a few questions that should be answered, such as, does the investment even produce a cash flow? Are you sure the asset will produce a positive cash flow in the future? When will the asset produce positive cash flows? Let's review some of these questions in more detail. Question: does the investment even produce a cash flow? People often think of a commodity, gold, Bitcoin, art, and land as investments. However, they do not produce cash flow. Therefore, the only way they gain value is if someone is willing to pay more for the asset or if the currency is being devalued. In contrast, things like stocks, rental property, and farmland produce income. Income-producing assets can be valued using the discount cash flow model. Professor Damodaran explains discount cash flow in more detail.
The other point I want to emphasize is intrinsic value is really designed for cash flow generating assets. So if you gave me a business, a stock, a young growth company, a startup, I can use intrinsic valuation. When can I not use it? Give me a Picasso to value. I couldn't give you the intrinsic value of a Picasso because it could entirely be in the eyes of the beholder. Another example, if you ask me what the intrinsic value of gold is, I have no idea. So intrinsic value is a technique designed for cash flow generating assets, whether it's a business or an individual asset. So having laid that as a basis, let's talk about discounted cash flow valuation. The equation that drives discounted cash flow valuation is a familiar one, at least for those who've taken a finance class. In fact, you probably saw it in your very first finance class. It says that the value of an asset is the present value of the expected cash flows on that asset. This is not rocket science. People have always understood the fundamentals of discounted cash flow valuation even before we in finance start to dress it up and make it look more sophisticated than it absolutely has to be. So in discounted cash flow valuation, it boils down to estimating cash flows and adjusting for risk. So how do you do that? There are two ways in which you can set up a discounted cash flow valuation. In the first, and this is the more common way, you get the expected cash flows on an asset or business over time, expected across all scenarios. And I want to emphasize that. If you do a true discounted cash flow valuation, you have to look at all possible outcomes, good and bad, and take an expected value across those outcomes. So the expected cash flow It's just the expected cash flow. It's not risk adjusted. The discount rate is where you adjust for risk. Riskier assets have higher discount rates than safer assets. Here's the alternative. Rather than adjusting the discount rate for risk, you can try to adjust the cash flow for risk. And a lot of people don't quite understand what this means. So let me be clear about what risk adjusting the cash flows would mean. Let's assume you have $100 in expected cash flows next year, but you're uncertain about those cash flows. Your risk-adjusted cash flow will not be $100. It'll be whatever you would take as a replacement for the $100 as a guaranteed cash flow. Now think about it. If you're risk averse and I offered you a choice between $100 of risky cash flows or some other number that's a safe cash flow, you'd probably settle for a lesser number, right? 90, 95, 92. That's called a certainty equivalent cash flow. It's a difficult thing to do, but you can do it.
Question: are you sure the asset will produce a positive cash flow in the future? Before doing any calculations, ask yourself, am I confident the asset will produce more money in the future?
For an asset to have value, its expected cash flows have to be positive at some point in time. Stating the obvious, right? But might as well state it. So if you come to me with a company that's losing money and you tell me you expect it to lose money forever, you know what valuation model you should use for it? None. That company is worth nothing to you. So for a company to have value, its cash flows have to be positive at some point in time. The key word is some point in time.
Question: when will the asset produce positive cash flow? The timing of cash flows does matter. Getting the cash flows sooner would let you reinvest the cash faster, creating more compound interest. Additionally, inflation makes the value of future cash flows worthless. Assuming a similar interest rate, assets that generate cash flows early are worth more than assets that generate cash flows later.
For a company to have value, its cash flows have to be positive at some point in time. The key word is some point in time. If you have a business with negative cash flows up front, it doesn't have to be a bad business, it could be a young startup. For that business to have value, it has to have disproportionately large positive cash flows in the future. Why disproportionately large? Because if you lose $1 billion in year one, you better make 5 or 10 billion in year 10 to make up for that $1 billion in year one. So when you see me valuing young growth companies a little further down the course, don't be surprised to see these companies have negative cash flows up front. In those year 1, year 2, year 3, that's okay. In fact, that's what you'd expect. But what you should also expect to see are very large positive cash flows down the road.